All right, welcome back, everybody, to the deep dive. Today, we're going to zero in on natural gas, especially for anyone thinking about trading tomorrow, Monday, March 24th, 2025. Consider this like your pregame analysis, getting you ready to make those smart trading decisions.
Absolutely. We've got this really in-depth market analysis we've been looking at, kind of gives us the whole picture of natural gas, supply and demand, all that, as of last Friday, the 21st. This is data-driven, no gut feelings here. Should give us a solid idea of how things might shake out tomorrow.
Exactly. Cutting through the noise, that's what we do here. We're pulling out the really crucial bits from this analysis, the things that are going to matter, the signs, the levels, so you know what's up when Monday rolls around and the natural gas market gets going. So first off, this analysis is pointing to things kind of settling around, like the $4 mark. What does that tell you right off the bat?
Well, think of it kind of like a tug of war, right?
Yeah.
And it's like stuck. Nobody's winning right now. That's consolidation, basically. The price isn't really moving much up or down. It's just kind of hanging out around that $4 level. What that means is buyers and sellers are pretty much evenly matched for now. So that $4 mark, it's a big deal. It's like where everyone's watching, right?
Yeah. And the analysis calls it a cautiously bullish outlook. What makes them feel even a little bit good about it?
Cautiously bullish means like we're leaning towards things going up, but, we're not getting carried away. So even though the price is kind of flatlining right now, some of the signals, the fundamentals, the stuff we're going to dig into, those are pointing towards a potential upswing. Nothing's guaranteed. You know what I mean? Hence the cautious part.
Gotcha. So don't go betting the farm just yet. Now we see support at 3.85 and resistance at 4.20. For someone new to all this trading stuff, how should they think about those numbers?
Think of support like a floor. It's a price level where the price seems to have trouble going below, right? At 3.85, buyers might start jumping in, preventing it from dropping further. Now, resistance, that's like the ceiling. At 4.20, you'll probably see sellers getting more active, possibly stopping the price from climbing any higher. If the price breaks through either of those, the floor or the ceiling, that could mean like a whole new trend starting.
Yeah.
So those levels, those are the boundaries to keep an eye on. Big things can happen around there.
Okay, floor and ceiling. I like that. Makes sense. Now, one really interesting thing is that natural gas storage is way lower than usual compared to this time last year and the average over the past 5 years. We're talking about a 624 billion cubic feet difference from last year and 190 billion cubic feet below the 5-year average. Why does it matter so much for the price?
Well, this is where supply and demand really come in. Less in storage means there's not as much natural gas to go around. When the reserves are low, especially as we get closer to the end of the heating season, everybody wants to make sure they have enough gas. And when everybody wants something, well, the price goes up, right? It's basic economics.
Yeah, less supply, higher demand, prices go up. Simple enough. But then we get this report, a little bit out of the blue, about a 9 billion cubic feet injection into storage on March 20th. That's kind of weird, right? We're still technically in a period where we usually see withdrawals. What could this unexpected build mean looking ahead?
You're right, that 9 billion cubic feet injection, that's early for this time of year. It could mean things are changing sooner than expected. Maybe the weather's getting warmer and people aren't using as much gas for heating. This little curveball, it could make things a bit shaky in the market. People who are counting on those low storage levels to keep prices high, they might have to rethink things, at least for now.
Okay, so things aren't always so straightforward. That brings us to what this analysis calls technical supply and demand zones. What are those exactly?
Imagine looking at a price chart, right? These zones are like areas on the chart where historically either buyers or sellers have gotten really active. So a supply zone, that's where we usually see sellers coming in strong, maybe stopping the price from going up. Demand zone is the opposite. That's where buyers are usually in control, pushing the price higher. Knowing these zones, it can help you guess where the price might hit a wall or find some support to bounce back.
And the analysis, it lays out a bunch of these zones. On the supply side, there's a major zone between 4.150 and 4.200, then a strong one from 4.350 to 4.400, and a heavy one between 4.50 and 4.50. What's the story behind each of these?
The big one, the major supply zone, 4.150 to 4.200, that one's important because the price has tried to break through there a few times lately and failed. Every time it gets up there, sellers come in and push it back down. That tells us there are a lot of sellers hanging out around that level. Now, the strong zone, 4.350 to 4.400, that one's got some history behind it. It was a resistance level before, so there's a good chance sellers will be back and forth there. And the heavy zone, 4.50 to 4.550, Well, that's the highest point the price hit recently, but there wasn't a lot of trading volume there, so it might not be as strong as the other two.
Okay, so lots of potential roadblocks to the price on the way up. Now, what about the demand side? There's an immediate zone between 3.930 and 3.950, a strong one at 3.850 to 3.880, and a major one from 3.750 to 3.80. What's the deal with these?
All right, so the immediate demand zone, 3.930 to 3.950, that's been giving the price a bit of a boost lately, although the trading volume there wasn't huge. Now, the strong zone, 3.850 to 3.880, that one's really interesting. It's been tested a bunch of times, and every time we saw more trading volume, that can mean big players, institutions, are stepping in to buy at that level. And that major demand zone, 3.750, 3.80, that's like a long-term support level. It's been holding strong since December 2024. That tells you there's a lot of buying interest down there.
So some pretty solid support levels there, too. The analysis also points to a potential rectangle formation between 3.850 and 4.200. For someone just starting to learn about these patterns, what does a rectangle usually tell us about where the price might go next?
Imagine drawing lines on that chart, and the price is bouncing between them like it's trapped in a rectangle, right? That's what it's all about. It usually means the market's taking a break. Buyers and sellers are kind of figuring things out. What's important is that eventually the price will break out of that rectangle. Which way it goes, that's a big clue about what's coming next.
So a rectangle is like a pause, a moment of tension before things explode, potentially. Now, even though we've got this sideways action lately, the analysis says the daily chart is showing a bullish market structure with higher lows since August 2024. How do we square that with the fact that the price hasn't been moving up much recently?
Yeah, that's something you see a lot in the markets. The long-term trend, those higher lows, they're telling us that overall the market is leaning upwards. This recent pause might just be that, a pause, like the market's catching its breath before it keeps climbing. Think of it like walking upstairs. You take a few steps up, then you reach a landing. You take a break, then you keep going up. Those higher lows since August, they show us the bigger picture.
Okay, so zoom out. It's still looking good. But zoom in. We're in a waiting game right now. Now, you mentioned trading volume before. The analysis talks about how volume was higher at that 3.850 to 3.880 support zone and lower at the 4.150 to 4.200 resistance. What does that tell us?
Higher volume at support, like down at 3.850 to 3.880, that often means buyers are really serious. When the price drops down there, big players come in with a lot of money and they buy it up. That's why the price bounces back up. Now, lower volume at resistance, up at 4.150 to 4.200, well, that could mean buyers aren't that interested in pushing the price higher. Might be a sign that the upward momentum is fading.
So volume shows us how much conviction there is behind the moves.
Gotcha.
Now let's look at the technical indicators. RSI is at 52.70, which is neutral. MCD is at 0.06, slightly positive, and the moving averages are all bullish. 50-day at 3.97, 100-day at 3.58, and 200-day at 2.95. What do we make of all these different signals?
It's pretty normal to see different signals from different indicators, especially when the market's taking a breather like this. RSI around 50 means things are balanced, no strong push in either direction. A slightly positive MACD suggests a little bit of upward momentum in the short term. The moving averages, they're all below the current price and sloping upwards. That's usually a bullish sign, pointing towards higher prices in the long run. So, yeah, mixed bag, but leaning towards the upside.
Okay, mixed, but more good than bad, maybe.
Yeah.
All right, let's dive into the fundamentals and what's been happening lately. We already talked about that surprising 9 billion cubic feet injection into storage. But big picture, storage levels are still super low, right?
Oh, yeah, definitely. That recent injection was a bit of a head-scratcher, but the overall picture hasn't changed much. Storage is still way below where it normally is compared to last year and the 5-year average. That's why I think we could still see prices going up, especially as we get closer to the next heating season. But yeah, that recent build, we got to keep an eye on that. It's a sign that things might be shifting earlier than we thought.
Okay, so something to watch. Now, the EIA, they put out a new price forecast in March, predicting an average of $4.20 per MMBtu for 2025. That's higher than they were saying before. Why the change of heart?
Well, a few things probably contributed to that. First, remember that cold snap we had earlier this year? That drained a lot of gas from storage, and that always pushes prices up. And then there's the LNG exports, which we'll talk about more in a bit. They're expecting those to grow even more this year, which means higher demand and higher prices. So yeah, those are probably the main reasons they're feeling a bit more bullish now.
Right. Higher demand means higher prices, usually. And speaking of LNG exports, they're saying those could hit 14 billion cubic feet per day this year, up from 12 billion last year. That's a pretty big jump. How does that affect natural gas prices here at home?
Think of it this way. LNG exports, that's another big source of demand for the natural gas we produce here in the U.S. We're sending more and more of it overseas, and that means there's less available here, which can push prices up. It's a big factor in the market these days.
So it's like adding a whole new group of buyers to the mix, competing for our gas. Now, what about how the big players are positioned and what the overall sentiment is like in the market? The analysis says there's a strong buy consensus. What does that mean exactly?
That strong buy consensus, it basically means that a lot of analysts, the people who look at charts and indicators all day, they think the price is going to go up. They're looking at things like the MOCD and the ADX, which measures how strong the trend is, and those are saying buy too. So based on the technical picture, things are looking pretty good.
And remember how we talked about higher trading volume at that 3.850 to 3.880 support zone? That could mean big institutions are buying there, right? How does that fit with this whole cautiously bullish sentiment? Yeah, it makes sense. When big institutions buy at a support level, it means they think the price is going to hold there and probably bounce back up. They have a lot of information, so when they make a move, people pay attention. It adds weight to that bullish outlook. But the caution is still there because of that recent sideways movement and that unexpected storage build. Not everyone is convinced that a big breakout is coming.
So mixed signals. Got it.
Yeah.
It's also interesting that the moving averages are giving different signals too. The short-term 5-day and the 50-day are saying buy, but the 20-day is saying sell. What does that tell us?
It basically shows you the struggle between short-term and medium-term trends. The 5-day average, that's super short-term. It's reacting to what happened just recently. The 50-day, it's looking at a longer period, so it still reflects that overall upward trend. But the 20-day, it's caught in between, reflecting that sideways action we've seen lately. It's like the market is at a crossroads right now, trying to figure out which way to go.
Okay, so it's a bit of a tug-of-war. All right, let's focus on those nested supply and demand zones now. The analysis is really highlighting the 3.850 to 3.880 zone for demand and the 4.150 to 4.200 zone for supply. Why are these areas so important to watch?
Nested zones, that's where things get really interesting. It's where support and resistance levels from different timeframes kind of overlap. They're like hot spots where you're more likely to see big price moves. So when you've got strong buying interest around 3.850 to 3.880 on multiple timeframes, that's a good sign that the price will hold there. And up at 4.150 to 4.200, that's where sellers have been really strong in the past. These nested zones, they're where the big battles happen. If the price gets close to one of them, either it'll bounce back hard or it'll break through and keep going.
So those are like the key battlegrounds to watch.
All right, let's add another tool to our arsenal, Fibonacci retracement levels. Based on that recent move from 3.850 up to 4.20, we've got some key levels. 4.065, which is the 38.2% retracement, 4.025 at 50%, and 3.985 at 61.8%. The price closed on Friday at 3.980, right around that 61.8% level. What's the significance of all this for trading on Monday?
Fibonacci levels, they're all about how much a price might retrace or pull back after a big move. So after a big jump up or down, the price often goes back a certain percentage before continuing in the same direction. The 61.8% level, that's a big one, often acts as support. The fact that the price closed right there on Friday, that's a good sign. It could mean the price will hold there and keep going up. But if it drops below those other Fibonacci levels, 4.025 and 4.065, they could become resistance, making it harder for the price to go back up. So Fibonacci levels, they can act like magnets, pulling the price towards them. Gotcha. Now, let's get down to brass tacks. What are the trading opportunities here? The analysis talks about both range-bound and breakout scenarios. Let's start with range-bound. What are we looking at?
Okay, so right now, the price is kind of stuck between 3.930 and 4.0070. That's our range. One way to play this is to buy near the bottom of the range, around 3.930 to 3.950. The analysis says you could enter around 3.940, put your stop loss at 3.915, and aim for profits at 4.0 and 4.070. That's a pretty good risk-reward ratio, and they say there's a 60% chance it'll work out. You could also sell near the top of the range, 4.050 to 4.070. Enter around 4.060, stop loss at 4.085, and target 4.0 and 3.950. That one's got a slightly lower chance of success, 55%. But both strategies are based on the idea that the price will stay within that range.
Okay, so playing the bounces. But what if the price breaks out of that range?
Yeah.
What then?
If it breaks out to the upside, that's bullish. The trigger for that would be a sustained move above 4.080 and ideally a close above 4.10 with high volume. You could buy on a pullback around 4.110, stop loss at 4.075, and targets at 4.150 and 4.200. They give that a 40% chance of happening. Now, if it breaks down, that's bearish. Trigger for that would be a sustained move below 3.930, ideally a close below 3.90 with high volume. You could sell in a pullback around 3.890, stop loss at 3.925, and targets at 3.850 and 3.800. That one's got a lower probability, 30%. So breakout trading, it's all about catching those big moves when the price breaks free.
So two different ways to approach it, depending on how confident you are in a breakout. Now, the analysis also talks about risk management, which is super important. What are the key things to keep in mind there?
Risk management is essential. You never want to risk more than you can afford to lose. The analysis says to limit your risk to 1-2% of your total trading capital on any single trade. That's a good rule of thumb. And since natural gas can be a bit volatile, especially when there's news coming out, it might be smart to use wider stop-loss orders. That way you're not getting shaken out of a trade by every little jiggle in the price. But if you do that, you also want to trade with smaller positions to keep your overall risk in check. And remember, the best time to trade is usually between 9:00 a.m. and 2:3 p.m. Eastern Time. That's when most of the action happens. And super important, know what would make you change your mind about a trade. The analysis talks about invalidation conditions. So if you're in a trade and something happens that makes you think your initial assessment was wrong, get out.
All right, know when to fold them.
Yeah.
That makes sense. Let's switch gears a bit and talk about correlated assets and seasonal factors. Crude oil. That's usually closely tied to natural gas, but that relationship has gotten weaker lately. Why is that, and what's driving natural gas prices now?
Well, crude oil and natural gas, they're not as connected as they used to be. Crude oil prices, they're affected by things like the global economy and what's happening in the world, geopolitics, all that. But natural gas prices here in the U.S., they're more about domestic supply and demand. Things like weather, storage levels, and LNG exports, those are the big drivers now. And speaking of seasons, we're kind of in a transition period right now. We're moving out of the peak heating season towards the shoulder season. March is usually when storage withdrawals end and injections begin. That 9 billion cubic feet injection we talked about, that might be a sign that the transition is happening already, and renewable energy, that's becoming a bigger player too. As we use more solar and wind power, that can affect how much natural gas we need for electricity.
Interesting. So less about oil, more about what's happening here at home.
Mm-hmm.
Now, let's look at some different scenarios. The analysis lays out bullish, bearish, and neutral possibilities. Let's start with the bullish one, which they give a 30% chance of happening. What would need to happen for that to play out?
The bullish scenario, it all hinges on the weather. If we get colder than expected weather in early April, that would be a big boost for natural gas prices. It could push the price above that 4.2 aura resistance level, maybe even all the way up to 4.50. Things to watch for would be a lot of buying above 4.0 and smaller than expected storage builds in the next few reports.
Okay, so fingers crossed for a cold snap. What about the bearish scenario? They give that a 40% chance. What's the thinking there?
The bearish scenario is all about the opposite, warmer than expected weather. If that happens, people will use less gas for heating, and that could put downward pressure on prices. If the price drops below 3.85, it could go all the way down to 3.60. Watch for heavy selling below 3.0 and bigger than expected storage builds.
All right, so keep an eye on the thermometer. And the neutral scenario, what would that look like?
The neutral scenario is basically more of the same. The price stays between 3.90 and 4.0, not really going anywhere. It's basically a stalemate between buyers and sellers, waiting for something to tip the scales. We'd probably see lower volume and volatility in that case.
Okay, so kind of like a holding pattern. Now, the analysis also mentions those unpredictable black swan events and the possibility of gaps over the weekend. What should our listeners know about those?
Yeah, black swan events, those are the things you can't really predict, but they can have a big impact on the market, like a pipeline explosion or some kind of geopolitical crisis or some crazy weather event. Those things can make the price go haywire. And weekend gaps, that's when the price opens on Monday, significantly higher or lower than where it closed on Friday. It happens because things can change over the weekend, news or sentiment. They say there's a moderate risk of that this weekend, plus or minus 5 cents from Friday's close. So something to keep in mind.
Always good to be prepared for the unexpected. Now, what are the big events coming up this week that could affect natural gas prices?
The big one is the EIA Weekly Natural Gas Storage Report. That comes out on Thursday, March 27th at 10:30 a.m. Eastern Time. That report can move the market a lot, especially now with everyone watching those storage levels so closely. Also, keep an eye on the Baker Hughes rig count, which comes out on Friday. That tells us how many rigs are drilling for natural gas, which gives us an idea of how much production we might see in the future. And of course, the weather forecasts, those are super important. Watch those daily. The analysis says it might be wise to reduce your trading positions ahead of those big reports.
Yeah, better safe than sorry. Now let's do a quick rundown of the visual analysis, the 15-minute chart. That's showing short-term consolidation. What's the main takeaway there?
The 15-minute chart, that's for the short-term traders. It's showing that the price is stuck in a tight range between 3.950 and 4,000. The volume is drying up, which could mean the market is getting ready for a breakout. Immediate resistance is up at 3.980 to 4.0, and support is down at 3.950 to 3.960.
And the 4-hour chart, that shows us that rectangle formation again, right?
Exactly. The 4-hour chart really emphasizes how important that 3.850 to 4.200 rectangle is. The price has been testing those boundaries for weeks now. The fact that the volatility is decreasing, that also suggests we might be in for a big move once the price breaks out of that range.
And finally, the daily chart. That's the big picture, right?
Yeah.
It shows that long-term uptrend, but also hints at some possible exhaustion.
Yep. The daily chart, it's all about context. That uptrend since mid-2024, it's still there. This consolidation we're seeing now, it could be a bullish flag, which often means the uptrend will continue. But the fact that the price is stalled after hitting those highs in early March, that's a sign that the momentum might be fading. Whether the price breaks out to the upside or reverses to the downside, that'll tell us a lot about where things are headed in the medium term.
Okay, so lots to watch there. All right, let's sum it all up for everyone out there getting ready to trade natural gas on Monday. The market is stuck around 4.00 right now, with support at 3.85 and resistance at 4.20. That surprise storage build last week, that's thrown a bit of a wrench in things, but overall storage is still really low. We've talked about different trading strategies, both for playing the range and for jumping on a breakout if it happens.
And remember those key supply and demand zones, especially the ones that overlap around 3.850 to 3.880 and 4.150 to 4.200. Those are the areas where you're most likely to see fireworks. And don't forget about that EIA storage report on Thursday and those weather forecasts. Those can change the game in a hurry.
So here's something to think about as we wrap things up. We've got this unexpected storage build, maybe hinting that the withdrawal season is ending earlier than usual. Given that, what's the biggest wild card out there? Something beyond the normal weather and storage reports that could really shake things up in the natural gas market this week. And how would you play it? Keep those brains working, stay informed, and we'll see you back here next time on The Deep Dive.